Thanks everyone for your time this afternoon. I just want to show you, first my sort of sidebar is that in the world of investment, this room knows this well. You look up at the scorecard very often. And when looking up at the scorecard, I'm reminded of Nadia Comaneci, the Romanian gymnast, when she looked up at the scorecard and saw 1 at the Montreal Olympics. Sometimes it can be that we look up at the scorecard and we see 1 because what we anticipate just hasn't materialized. But over the last couple of years on the Manual of Ideas platform with John Mihaljevic, I've been presenting our sort of core concentrated ideas from a domestic investment perspective. And these were the ideas that I shared on that platform in 2019, 3 ideas. And those 3 ideas returned collectively 21% in 2019, which against the domestic landscape, that was a very good result because that was 13% ahead of the domestic market. In 2020, we had another good year. The domestic market returned 9% and we returned 31% on these 3 core ideas. So 2 good years back to back. But when you look up at the scoreboard, it's still not a 10. And the reason why I'm complaining about it's still not a 10 is you'll see that sitting in the middle of my deck here was the reference to a company called Saville, which did -7, and then Saville, which did -8. So of my 3 best ideas, 2 did well and 1 did nothing or a little bit backwards, and then 2 did well and 1 did nothing or a little backwards. Our investment philosophy, whether we're looking at domestic markets, regional markets, or global markets, is heavily influenced by some of these giant minds, with the simple argument being that the further back you look, i.e. learning from others standing on the shoulders of giants, the further forward you can see, with a small set of principles that translates into investment philosophy. So our principles include being unconstrained, that what Stephen's talking to here, top down, matters as much as bottom up, that history matters, that capital allocation actually starts with managing risk, not looking for return. And that if risk goes out the door, return goes out the window. That cycles matter, and we pay very little attention to forecasting, worrying really about the price we're paying and the quality of the asset that we are getting for that price. And to turn that into practice, we have a very disciplined, repeatable and scalable investment approach popularized by Michael Lewis in his Moneyball, but leaning on the types of processes that practitioners and philosophers like Aswath Damodaran would reference. So here's a schematic of our investment process, starting with risk, then looking at the quality of the asset, turning attention to valuation, and then finally from that we put together a portfolio. And I would venture that, whilst I'm speaking here in the context of my idea, which is a public market idea, there is nothing in this that won't speak to private markets either, whether it's venture capital, private equity, secondary private equity, or other. What's especially interesting in African markets, and the South African market is no exception, is that the habit of investors is they tend to follow a small set of well-researched names, and then you have this long tail of unresearched names, which results in huge information asymmetry and inefficiency in the market. And with a little bit of homework, it's quite possible to find the likes of Ben Graham net in quite well-established markets, i.e. companies who have more cash on their balance sheet than market cap. And we very successfully invested in a couple of those businesses over a number of years. And so by going down into this admittedly higher volatility arena, but if we can tolerate the bumpiness and if we can peel back the surface and go digging where others sort of are not bothered to look, We've run a portfolio over just over 20 years. It's launched in the mid-1990s, and over that time, the domestic market's done 14 times capital. This portfolio did 39 times capital, with a very, very different set of ideas. But of course, you don't get 39 times capital by hugging an index. And when it comes to thinking about the types of assets that go into this portfolio, after satisfying ourselves with risk criteria, attention must turn to valuation. And this data that I'm sharing here, I think, surprises many people, especially those in corporate finance, because what it shows is very powerful mean reversion in growth in earnings. And we've got similar data on return on equity, that companies simply don't compound at the imagined rate when analysts first get hold of them, and that they quickly have those competitive advantages competed away. And indeed, the bulk of companies struggle to earn much more than their return on invested capital. And that then leads us to think about valuing businesses in three ways. The first is just asset power. If the company burns down, what would we get for it? The second is earnings power, which is we don't give any benefit of the doubt to the business, and we value its earnings discounted to current value, not allowing for any growth unless they have demonstrated a sustained competitive advantage. And so to this end, what if I could find a company that seems to have franchise value, i.e. it can earn more than its return on invested capital, and I can buy it at a discount to net asset value? Then you've sort of found the golden result. And the company that I'm referencing is a business called Saville Limited until last year, when it changed its name to Saville Capital. In the interest of time, I'll flip through this very, very quickly. This is just a valuation on different parts of the South African market, where if you're down in the small cap territory, you're likely to find far more attractive valuation than the rump of the market. That there is this attribute of businesses that compound quite neatly with economic growth or economic underpin. But what if I could find, referencing again that Saville Capital idea, businesses that are compounding but have been priced as if they aren't compounding? And that's exactly what we've found in the case of Saville Capital. In the interest of time, I'll just flip through this. I spoke about this a little bit last time, the attributes of the South African economy. Mark has already spoken to this, with the economy and policy wrestling with some real demons, and not much to be too bright-eyed about in the South African landscape. But what if I could find a business that compounds powerfully, and I can buy it at a discount to its intrinsic value? Then you've essentially got a hedge fund. You've got a geared compounder, which is a very powerful animal. Amit Wadhwani from Mirrors Capital in New York gives this thesis around finding these types of discounted compounders, essentially holdcos, where you're getting some play on net asset value, but that net asset value has got a compounding machine inside of it. This chart shows you a snapshot of the South African market, where there are some businesses with very, very deep discounts to net asset value, but they deserve those discounts to net asset value because they aren't creating capital, they're destroying capital with negative return on equity. But in this same terrain of minus 40, minus 50% to net asset value, you've got businesses that are compounding at 10, 15, 20% per annum. And so inside of this cluster of these 40 and 50% discounts to NAV, is this sort of golden or sort of hallowed cluster of really interesting ideas, where we can buy them at 50 cents in the dollar, and they're compounding at 15 or 20% per annum. And it's here that I've got this particular case of Saville Capital. There's a whole bunch of slides that follow on this, and Mark, to try and hug the times as closely as possible, I won't take you through or torture you through the slides. I'll just give some of the headlines on Saville Capital. The first is half of the balance sheet is dollar-based, which is really interesting. So you're buying a South African priced asset, but you're getting half of the asset in dollar, which means if I'm paying 50 cents in the rand for this business, I'm actually getting, to Stephen's earlier point, like Amazon, I'm getting all of the dollars. I'm paying for the dollars, but I'm getting everything else for free. This business has a long history. It's established by Christopher Seabrook in the 1980s and listed on the Johannesburg Stock Exchange without interruption from them. It's been through some convoluted and complicated and unnecessary structuring. That's legacy. And most recently, they collapsed one last layer of structuring by moving low voting shares and high voting shares into a single structure. Here's the compounding story of this business. If you look at what happens to net asset value over its lifetime, and if you look at what happens to the earnings and the dividend stream, including a number of special dividends over the years. So here's a business that has produced a return on invested capital a long way above the weighted average cost of capital. But when I presented this case in February of this year on that platform, that global platform, Manual of Ideas, as our best idea, it was trading at 35 Rand with 60 Rand of assets. Not quite 50 cents in the dollar, but very, very close, 60 cents in the dollar. Since then, the share price has shifted meaningfully higher. It's moved from 35 Rand to 50 Rand. So we've had an almost 50% return on capital from the start of this year. But more than that, they released results on, what day are we on Friday of last week. And in that results release, they moved their net asset value from 66 Rand a share into the 70s, evidencing a 15% growth in net asset value over the past 6 months. This gives you a sense of the diversification. A large part of the portfolio is in unlisted assets, including agriculture, infotech, industrial foods, and I love this observation from Matthew McLennan. It says, we like to plant seeds and watch the trees grow. And our portfolio is often kind of a portrait of inactivity. And I think SabCap is a great example of this type of opportunity in an unexplored market, or a relatively unexplored market. Maybe as the last point, Mark, I can just add this observation that, here is a single example in an African context. I could take you a little further northeast of South Africa to Kenya, where a bank, Equity Bank, has just released results. Return on equity for this bank is 20% per annum over the last 10 years, or return on equity averages 20% over the last 10 years, and price to book multiple is 1.5. A large number of these ex-South African, Pan-African banks are trading at price book multiples of 1 and lower, with return on equity of 15% and higher. Mark, I hope that got closer to my time collateral. Thanks for the opportunity to present.
So it sounds like the stock that you've been backing in 1920 is going to have its day. It's having its day in 21.
From your lips to God's ears.
Which reminds me of some of the small cap stocks that Stephen talks about, or his team. They're part of that tail no one focuses on sometimes.
Yeah.
Questions about, I mean, this is just one part of sliver of what Adrian knows. You talk about other asset classes across Africa and all this. its countries. Any questions, comments on Africa or what Adrian shed light on?
Yeah, Adrian, quick question on most of the probably more market-driven investments, or at least ties to investments, are probably, I'm guessing, a majority of them are run out of the South Africa area. That could be sprinkled out throughout Africa, but with the unrest in South Africa, how is that really kind of playing a part on the disruption of, you know, trying to at least get a stable investment economy there?
You know, so Luke, the point that you make about South Africa is South Africa has been in structural decline for some time. And I think you have to invest, you know, with that hat on, that there's no time soon that South Africa is going to step up and become a 5% economic growth powerhouse. What we do have is we have a very developed capital markets, sophisticated and well-regulated capital markets, including the equity market, the bond market, the bank market. The currency also is well managed and well regulated, with an extremely disciplined reserve bank, and so you can put aside sort of hand-wringing or anxiety about sort of Venezuelan or Argentinian type risk, and so that allows you to really then focus on the nature and the quality of the assets. And in the case of SABCAP, it is overwhelmingly ex-South African assets, including businesses in Bangladesh, in Hong Kong, or if they are South African assets, they're South African assets with dollar earnings, such as their agricultural and mining operations. So you're buying then, you know, something that is priced as if it's South Africa, but it's anything but South Africa. And I think that that's a great case of buying good assets at very depressed or misunderstood prices. Of course, you know, what it needs is a catalyst to unlock that trapped value. And we think that there has been some interesting price discovery coming out of US-based investors into SABCAP, seeing this big discount to NAV. I think you're asking another point, though, and that is, you know, how's South Africa doing from a broader perspective? And there's a number of good reasons to be anxious about the country. Regulatory risk, political risk, but it would be grand or bold to, you know, put it into sort of a failed state or a collapsed state, as some commentators have been attempted to do. The recent riots was a manifestation or demonstration of long-standing troubles in South Africa: inequality, unemployment. There's nothing new in that. Sadly, there's nothing new in it. And those riots and protests were relatively isolated, and I would suggest sort of in the rearview mirror, that they're behind us for now.
Hey, Adrian, very nice presentation. I felt like I was back in the 80s there for a few minutes with some legendary value guys who gave me briefings way back at the start of my career. So, you know, kudos to you. I'm curious, is the South African market sort of a unique oasis that works well with your overall approach? And I guess the follow-up question to that is, have you looked more globally, again, kind of seeing if there are similar types of opportunities, you know, again, kind of using your whole framework?
Bill, thank you. I wasn't sure if that opening comment was going to land up as an insult or a compliment.
All good. All good.
I'll take the 1980s value as a compliment. Thank you. I run a global portfolio. It is a concentrated set of names, 35 names, benchmarked against MSCI All World Index. I've run it since 2007 with this type of mindset, but you'll appreciate that it's speaking to global capital. It can't be nearly as concentrated or have as deep an investment, a value orientation. But you can go in that direction. And although many international markets are far better researched than the South African market, you find some examples, given the size of the market, that can really throw up attractive opportunity. A great recent case in point is Altaba, which was the Yahoo spin-off of Alibaba. And that was trading at, it was a free lunch trading at 70 cents in the dollar. All you had to do was wait for the unlock. And when it came, it popped. Now, the trick was, would you know when it would come? And, that's always the head scratcher. But it arrived, and it gave us that 30% pop in capital. But that we're looking at a universe of 5,000 companies with this very disciplined approach presents example after example across markets, including established and well-researched markets, most obviously the US. So yes, there are many examples of these types of ideas globally, including the US. Mark has left us to talk amongst ourselves.
Yeah, I don't know if Mark is having connection problems.
I was waiting for Rob Colorina to speak. I was just waiting and waiting. He doesn't know that he missed the presentation, but he's so good that he could take one word and make a comment.
I'm on now, but I'm following the logic. Adrian, if I may ask, we invested in South Africa from one of the airlines there, and actually bought a business from Carlisle Europe in Northern Africa. But the TSL circuits. My question to you is, if it has been brought up already, forgive me, but can you speak a little bit about the relative political stability and comfort around that? With the Zuma situation, and I'm comforted that Ramaphosa, I think he's a dollar billionaire, and he was well liked by both the establishment, but then also I think he was on Standard Bank and Coca-Cola's board. Having a business type of perspective, I think that gives credibility. But I think from the Western side, we're U.S. based. How do you give comfort, particularly to the institutional and the DFI investors there, that this is more of a bump in the road versus deeply systematic?
Rob, I don't think it's a bump in the road. I think it's systematic or structural, that South Africa is in a state of, runoff. And I don't want to be dramatic, that it's, and I made the point earlier, if you joined late, you will have missed it, but I was making the observation that South Africa is not on the cusp of collapse, Venezuelan style. And I would approximate it more to sort of Argentina in just sort of slowly losing pace, but not about to default on its international debt. All of that said, South Africa is not about to jump out the box with 5% economic growth and solve unemployment, which policymakers keep promising. So, you've got this overpromised, underdelivered reality, and some real investment problems. You mentioned the airline that was put into, I'm not sure which airline you were invested in, forgive me, but South African Airways was put into business rescue. That was the national carrier. Eskom, the power utility, is in real balance sheet stress. And those are, I think, fairly permanent headwinds. But if you know the headwinds that you're dealing with, you can price that into your risk cocktail. So, I'm not euphoric or, wide-eyed about South Africa's prospects, but I think you can find good assets. Given the openness and the regulation of the economy, you can find very often global positioned assets that are well managed, well regulated. And some of these might be better known to you, the likes of Old Mutual, a global insurer trading at less than embedded value, Investec, the South African and European bank trading at book value, and Naspers and Prosus with the big Chinese footprint trading at 50 cents in the dollar, although they've got the Chinese regulatory problem to deal with. But I'm not wide-eyed about South Africa, but I think you can be constructive if you catered for the risks.
Adrian, beyond South Africa, where do you see the best opportunities and the biggest concerns?
Stephen, that's an African question, just to be clear.
Yes.
Okay.
Yes, that's correct.
So, I would divide it up regionally and very briefly. In West Africa, I think by far the most interesting markets include Senegal and Côte d'Ivoire. But if you want to buy listed assets, Senegal and Ghana are interesting. Nigeria is a real regulatory risk. It's not unusual for Nigerian regulators to jump out the cupboard and tell you you've received a $1 billion, $5 billion, or $10 billion fine. And that's happened to a number of assets in that market. So I've got a strong bias to Senegal, Côte d'Ivoire, and Ghana because they've got good growth structure and they have better regulated markets. In East Africa, you're almost spoiled for choice. But Kenya is by far the most well managed and well regulated. And I referenced Equity Bank, which trades just over book value, the price just over book value, 15% return on equity over 10 years. And it's a regional consolidator with some interesting fintech businesses. And then in Southern Africa, in Central Africa, nothing to talk about. There's nothing that is investable there. And in Southern Africa, Zambia has some interesting assets, but the economy is tricky. But Zambia does have some interesting mispriced dollar-based assets. Zambeef would be a case in point, listed on the London Stock Exchange. So you've got the comfort of having a well-regulated and well-traded market as a secondary listing.
Thank you. Great job.
And Adrian, other than country by country, if you're an allocator of assets, from venture upwards, I don't want to bias your answer. So what I give you, you're in a 10 billion endowment. What percentage do you allocate to Africa and to which asset classes?
Wow. If I lived on Mars, Africa accounts for a couple of percent of global GDP, and even less than that in terms of market cap. So anything, over a few percent in terms of allocation to Africa by GDP or market cap basis would be an alpha call on Africa. I would be very careful about regarding Africa as a place, Mark, and that's what I spoke to when I presented last time. So if you allowed me to allocate geographically inside of Africa, that would be my first insistence. And the second is private equity. To Rob's point, there's some very attractive private equity opportunities in the African contexts. There's some interesting infrastructure opportunities from road to rail to telco, and in listed capital markets, including bonds and private equity, public equity. So I think we actually, spoiled for choice in the African market. You've got great valuation. The question is not can you get in, but can you get out? And once you've satisfied for that, I would put together a basket of those public and private assets, catering for geography rather than for specific asset class.
Fair enough. Any other questions, comments?
Adrian, just a couple questions here. So if an investment was to be done in Africa, would you do it in a single investment opportunity, or would you kind of do kind of like a investment for a microeconomy to help support the investment?
I haven't understood the question, Luke, sorry.
So a single investment for a single opportunity versus a multiple investment in building out, supporting the, I guess, the microeconomy around it to ensure the investment works.
Yeah. So there's huge scope and capacity for impact given the base that you're coming off. We've done quite a bit of work on understanding political risk, capital risk, and regulatory risk on market entry. And interestingly, in our work, what we find from a Pan-African perspective, the best risk to manage is social risk. Indeed, if you've managed social risk, you've probably solved for political risk and regulatory risk. So if I've understood your question correctly, Luke, that's the direction that I would head in. I would want to invest in businesses that are going to have impact, which will translate into sustained and elevated return. Recently, I did a project for a private equity business called Convergence Partners, which has investments in ICT in 9 African markets. And that was our interest: is where are you having impact? And if you've got that impact, you've got the double whammy of not only abnormal returns because it's Africa, but abnormal and sustained returns because it's Africa plus impact.
You know what? This is Rob. One other quick thought is that, and Steve, you might have commented on this on something recently. Sort of the instability in Afghanistan and Middle East actually may put folks more thinking towards sort of areas that aren't as connected to that and benefit sub-Saharan Africa. Adrian, I'm not sure if you've thought through that, the ramifications of Kabul and Afghanistan and Middle East towards this.
Yeah, I guess, unfortunately, the reality is small markets, and Africa is a small market, tend to be risk on, risk off. And if you've got global events, whether it's Afghanistan, Chinese regulators, when those events spook global investors, they head for the same place. I'm far more interested in looking through the cycle and understanding the risk of my context. And if I've got my arms around the risk of context, then I can be reasonably comfortable allocating to Kenya, to Senegal, that this too shall pass in terms of sentiment. It doesn't take away the here and now of anxious moments. Funnily enough, Rob, to maybe take one step further from your observation about Afghanistan and Kabul, is the events of 2020 in terms of COVID was probably one of the greater gifts to African markets, because a number of industrial businesses have started to look at supply chain risk and to move or to disaggregate production. And we've seen quite a few investments move from China to African markets.
Adrian, just one more question about the port control around Africa seems to be heavy on Chinese ownership. How much does that have a play on investments for import-export?
Yeah. So, Luke, let me give you two throwaway stats. The South African businesses are bigger investors in in Africa than Chinese businesses. So South Africa actually has a larger collective investment than China, and so does the United States. So there's a huge amount of sort of media that feeds into this. There is, of course, some type of, I need to manage my language very carefully, but I'm speaking amongst friends here. If you'll forgive me for my language, but there is a proxy war, and I don't mean hostile or hot, but there is a proxy war for territory going on, and one of the assets is access to market, and ports and infrastructure, transport infrastructure, are the way to secure that access to market. It does surprise me how sort of quiet the US has been in this positioning, and that you've seen being very vocal and active. Turkey has been very, very busy in Africa. And the Chinese have been very, very busy in Africa. I am surprised just how sort of quiet or beneath the radar the US has been. So those assets are critical to market access.
Adrian, you mentioned that you have businesses that are relocating from China to Africa. What kind of businesses are those?
So they tend to be one of two flavors, either some form of early stage industrial activity, early stage manufacturing, and that's your old-fashioned sort of a flying geese Asian manufacturing business, including clothing, textiles, shoes, footwear, so those types of businesses, or fintech, because this aspect of some African markets is not as well known as it could be, and that is that you have substantial fintech capability in the likes of Kenya and South Africa are standout examples. Rwanda increasingly so.
Is that fintech capability coming from the talent pool, you mean?
Sorry, from the, Adam?
From the talent pool, the educated,
yes,
professional.
Indeed. So you have you've got in places very sophisticated financial markets, South Africa, coupled with enclaves of educational excellence. So South Africa, when you look at the World Bank tables on education and science and maths, South Africa is a disaster. But you have a little town called Stellenbosch, and Stellenbosch produces these wizards of tech. And you put together the finance and the tech, and you build these really interesting businesses that pop out of this tiny town just outside of Cape Town, including NASDAQ listings.
Yeah, as a follow-up question to that, that's a great question, Adam and Adrian, for answering that. So a follow-up question on that is, how much is the mix of investments or opportunities like that for companies that go in there are actually supporting the actual local economy, and local could be immediate local versus country local, to actually global contribution? That's what I think is really a misunderstanding with the investments in Africa. It seems like a lot of the investments or opportunities there are only supporting just the local economies in some way, form, or fashion, because it's so broken up and still evolving and maturing. But it just seems like a lot of those are all localized investments, and very few of them are at a global contribution stage to where it actually brings more money into the economy.
Yeah, there is that disconnect. I would agree with that, Luke. The chance to, or the opportunity to, really pull that lever is lost in in some places. The example that I gave recently, or that I gave now, is the recent listing of a company called Karoo, which is a vehicle tracking business built in South Africa, listed on NASDAQ. But the capital doesn't return to South Africa. It goes to find opportunity in Asia and so on. So that component of the investment channel translating into domestic impact sometimes, by no means always, but sometimes is lost.
Adrian, you had mentioned earlier in the presentation that the situation in South Africa is okay, taken care of for now. What do you mean for now? Is there a timeline for that? Is it
Hey, Adam knows Russia too, and Eastern Europe. Adam and Mark. So this is interesting perspective.
Yeah,
we lived in for now, right, Mark?
Yeah, for now. So I was told by one of my financial directors, if you forecast something, forecast an event and a price, but never both. And I'm not trying to be disingenuous by sort of kicking that to the side, but South Africa is a country that has walked on a knife edge for decades. As long as I've been aware, alive to capital markets and economic and social circumstances, well more than 30 years now, South Africa has always been a troubled place. Never a disaster, but always troubled. And, I guess that's what I'm trying to convey, is there's nothing that I see that suggests South Africa anytime soon is going to become the economic miracle of 5.4% economic growth that the policy papers talk about, and getting unemployment from halving unemployment in 10 years. It's simply not going to happen. But that doesn't mean that the place is a disaster. It's stressed, it's difficult. There are particular strains and challenges. You probably don't want to send your kids here to start their careers or to study at university. In fact, you want to go the other way around. But that doesn't change the investment landscape and the economic prospects. It is investable, and there are some very attractive assets.
And to your point, and by the same token, neither is it in a position, and you've made that clear before, that it's going to spiral into a Venezuela type of situation or anything like that.
Yeah, Adam, can I finish your sentence and say for now? And okay. I would have, I would put some clear biomarkers on that. And one of the most obvious biomarkers to me is the fierce independence of the central bank. And if that Reserve Bank independence is compromised, all bets are off.
Adrian, just a quick.
Sorry, Rob, I've lost you.
Yeah, I think he's gone off. I think he's in the Hamptons, or no, he's in Connecticut. Because if it's the Hamptons, terrible coverage.
Good place to be, but he knows how good the Stellenbosch wine is.
But within the malls of Johannesburg and Gauteng and Cape Town and Durban, or just the commercial areas and the hotels, was there physical safety risk that the South African locals or the expats? What was your feeling there? Because I had a feeling that was more towards the this was a little bit more media played on the townships.
Mm-hmm. I got the back end of your comment, but get the gist of it. So it was a time of anxiety, but not real physical risk, and that anxiety was fed by fierce media, wide broadcasting. You could almost argue, I don't want to say irresponsible broadcasting, but it was just uninterrupted channel stuffing of malls being looted, and lives were lost. The official estimate is 400 deaths. I'm telling you that number is a low ball. It was comfortably double that underreported deaths. But there was no time at which my sense was people are going to invade my home or seize my property, or I better flee to the airport and get out of here. That lives generally, are, or safety and security generally is good. And the looting and rioting were very specific pockets, as you've pointed out, parts of KwaZulu-Natal, just north of Durban and south of Durban, and parts of Johannesburg, especially the townships of Soweto and Alexandra.
And just the footnote there is on the U.S. side, what happened before, at the end of the Trump days was the riot and the approach to Capitol Hill, where you had congressmen and senators on both sides in harm's way. I don't think they did that in South Africa, in Pretoria.
No.
Yeah.
No.
Adrian, is there a reliable media source about what's going on, like in Africa, either on the, you could say, looking at the business climate, or the business environment, and or some of the other things that you're saying? Because you have mentioned a few times about how, in a sense, the at least international media coverage is always kind of biased or skewed toward, you could say, the more sensational parts of it. So is there any media source or media sources that you follow that you find reliable?
And is your question South Africa or Africa? Sorry,
I guess Africa in general, but
Okay.
South Africa or any. I'm personally also kind of interested in Nigeria. I don't want to take up too much time on this call, but I really, I have some personal contacts in Nigeria, and I was really kind of struck by what you said about it. And I'd love to have some, sources of information that are not, giving the kind of bias that you said makes it confusing to look at.
And I guess my response might be a little bit circular, because in fact that's the information asymmetry, is because there is this sort of distortion of reporting or presentation, and I can think of the front covers of headline magazines, which either get it spectacularly right or hopelessly wrong. But Al Jazeera tends to provide good broadcast coverage. There is a South African radio station called Power FM, but it reports Pan-African, and a publication called The New African, which is a regular publication. So the New African, I think, is a good place to go for reliable, unbiased, pretty balanced reporting.
Any other comments, questions? Well, Adrian, I knew that you had a lot to give, because we only gave you 10 minutes before, and I knew there'd be a lot to tonight. So this is great. I mean, for ourselves, we're trying to find emerging market managers. We're also looking, to my earlier question, more on the venture side, trying to have a group of funds that have been performing, referred by LPs that are in our network. So that's where we've been focused at the moment. on both of those barbells. I suspect there are probably some good deals. But actually, I'll look into how the vintages have performed. I feel like they've underperformed in private equity, but I could be wrong. But if you have, and I think with venture you have a long-term game, but you're probably right on the value and some of the other stuff. So I had a feeling you'd open our eyes, and that's what you did. So really appreciate it. And hopefully, and it looks like we'll see you in the Midwest as you come over, and we'll continue these conversations.
Trying my best.
Certainly, us Midwesterners would certainly love to have you.
It'd be wonderful.
Is the hospitality coming out already? All right. Well, thank you, everybody. Appreciate it.
Thank you.
Thanks, Stephen.
Thanks, Mark. Treat next week with Nitin presenting. He'll have some really good stuff. So tell your friends, join that one. I'm sure he'll bring a lot of insights. So thanks. I'll talk to you guys in a couple weeks.
Thanks, Adrian. Thank you very much. Really, it was
Thanks, Lauren.
very
Bye-bye.
insightful. Thank you.
Thanks, everyone. Cheers.
Bye-bye.